Hello, this is Greg Peck from Benchmark Home Loans. Just wanted to show you a quick video on private mortgage insurance. I know it's not the most exciting thing, but it's real important to take a look at this. Right now, there's two options. This is just dealing with conventional mortgages. It's not FHA or VA, just conventional Fannie or Freddie type of mortgages. Now, with private mortgage insurance, there's a couple different ways to do it. You can do the monthly PMI, or you can do the single premium. Now, the monthly PMI is the most common one. Most people don't know about the single premium, so I'm going to explain it here real quick. And this is real important because it's going to save you some money. It's going to save your borrowers some money. It's going to save your family members some money. So take a look at this. And once again, it's not about the payments. I understand it's about the long term, but the reality is that most people aren't going to be in their house more than 5 to 7 years. So that's going to change. So yes, I totally understand that people say, well, Greg, it's not about the payments. It's about building wealth and all that, being in my house, and these people running numbers over the interest payments for the next 30 years and so forth. But the reality, I bet for those people aren't going to be in their house more than 5 to 7 years. So a lot of those numbers don't mean anything anyway. So let's talk about what's happening today. Okay, so what's happening today? Let's say you're buying a house, and let's say you didn't have 20% to put down. Okay, so now you need private mortgage insurance to do a conventional mortgage. Now let's say you did 5% down conventional. Okay, right now the scenario one here is the monthly PMI. Okay, I'm just going to do a simple one here. Okay. There's a loan amount of $100,000. The PMI roughly is about $78 a month for that. Principal and interest payment on $100,000 is $521. The total payment of $521 plus 78 equals $599. Okay, so it's about $600. That's the most common way. It's a monthly PMI. Look at the second scenario. This is the single premium. Let's say there's a loan amount of $100,000. The PMI total is $2,700. Okay, you can take 100 plus 2,700. And that's $102,700 total loan amount. Your total payment's going to be $535. Okay. Once again, I know it's not always about the payment. It's about trying to build wealth eventually and so forth. But the reality is that most people aren't going to be in their house more than 5 to 7 years. So, what benefits them today? What can help them? Sure, the amortizing $2,700 over the long term. Yes, those numbers don't make sense if they stay there for 30 years. Okay. If they didn't, then this makes sense. $535 minus the $599, you're saving about $65 a month. 65 times 12, and then so forth. So just start doing the math on that. But right now, this seems like a much better deal these days. Okay, so I just wanted to show you that real quick here. This is the monthly PMI, which is most common. This is a single premium. We get to roll that back into the mortgage, and your payment on 102,700 is $535. So it's a higher loan amount. Okay, same rate. These interest rates are based on, I think I did about 4.75, I believe, on this to try to get these payments. But you're looking at $535 plus $599. That's $65 a month. That could be gas. That could be groceries. You do the math that way. Once again, this is Greg Peckman from Benchmark Home Loans. Don't hesitate to call me. Here's my phone numbers. Here's my emails. And thanks for listening. You guys have a great day.